Okay, so I think I'm being given the go-ahead to start. So I'm going to start, and keep in mind, guys, I have just one screen at the moment for the meantime. So I'll be switching between the PowerPoint slides and the chat forum to get your feedback. Okay, just to get any questions, but also feedback throughout the session. Okay, let's start. So today, the webinar will be covering market outlook for the fourth quarter and final end of 2012. It's just a quick overview in a subject area that I'm going to go into more depth in future webinars every other month in the remaining part of this year. Keep in mind that the summer months of 2012, I organized exclusive educational webinars which covered various trading techniques and how to increase the probability of basically protecting your capital and minimizing risk. Now, we finished the summer season of educational seminars, and what I want to do now is just keep it focused on market views, and there's plenty of market trade ideas to discuss. So today is Wednesday, the 12th of September, 2 p.m. GMT, and as always, dialing in from Switzerland. Please take note of my contact details. If you wish to email me with any questions, please contact me on rwilliampr@gmail.com, rwilliampr@gmail.com, and also you can follow me on LinkedIn, Twitter, and forexstreet.net for ad hoc blogs that I may update in the future. Okay, just a quick summary on the key trading techniques that I follow. For those of you that might be new to my webinar, I've been in the market now for just over 13 years officially, much longer in terms of experience, but officially 13 years. And certainly maybe one of the peaks of my experience was when I was working at Bloomberg, the international financial data company based in London. And in there I focused on technical analysis strategies, and we basically covered a global client base. We would visit banks and funds and try and develop new techniques of looking at the market, but also re-clarify old classic ways. And through the entire period of my career, the key thing I've always focused on is market timing, market timing, market timing. And one of the best ways to do that is to try and learn as much as possible about market cycles. And cycles, all I mean is just trying to understand a potential roadmap for where the market might move. But of course, that would be based on historical past movements, patterns, and cycles. So cycles is a key thing I look at every single day. And then more specifically on the trade setup side, as you can see there, number 2 and number 3, Japanese candlestick trade setups, and in addition to that, advanced indicators such as DeMark indicators developed by Tom DeMark. I also use my own proprietary strategies as an overlay. But keep in mind that Japanese candlestick trade setups, the majority of Japanese candlestick patterns are reversal oriented, so they tend to be good in volatile markets and calling market swings. And DeMark indicators are also primarily counter trend indicators. You can use them for trend following and then maybe try and identify when that trend is exhausted, or in addition to that, as I like to use them, for actual counter trend trades. Okay, and as I mentioned before, I'm based in Switzerland. Now, the weather isn't as nice as this photo here, which I took back in the summer months, but this is a very nice area where I live near. And I showed this to you just to kind of reach out to you and connect with some of you around the world, but also to try and share maybe some of your perspectives from each of the countries that you're living in. What I'd like to do is, as always, ask where in the world you are coming from, and also invite you to send a photo of that country to my email address, ronwilliampr@gmail.com. I've already received a few wonderful photos from some of you here, so thank you so much for that. I'll potentially include that in my next webinar, just to kind of so each of you can see each other's destinations around the world. I'm going to quickly flip back to the chart, to the chat room now, just to quickly ask my routine question. How many of you, which countries around the world are each of you from, and how many of you are new attendees or repeat attendees? So if you could just give me a quick survey. Which countries are you from, and is this your first or repeat time? So just a quick routine check, and if FX Street could just snapshot this screen, it'd be very appreciated. So we're getting here Zetolas, Portugal, Harley, US, not new, Shugai, repeat, Boyke from Africa, Gam, Higher Hampshire, England, and Anolhard. Gam, thank you so much for your photo. I did receive it. Beautiful photo. Hans-Jürgen, Germany, repeat. Jan, Brazil, repeat. Fernando, Portugal, repeat. Canada, Toronto, repeat. Offender. As always, you describe yourself as an offender. Mike Chandler from the US, regular fan. Thank you so much, Mike, for a fantastic photo of where you live. If it's okay with you, I'd like to feature that in the next webinar. Pontypool, front row, Wales, UK, new user. Carlos, US, loyal fan. Thank you so much, Carlos. Haitham from Saudi Arabia, and Ecotech from Cape Town, repeat, and ET from France, repeat. We have a wonderful, wonderful demographic there from around the world, and so everything from the US to Europe to the Middle East and beyond. So welcome to all of you repeat loyal audience, and to some of you who might be here for the first time. I really hope that you enjoy this session, and please take note of any interesting trade ideas that we discuss, but also feel free to ask questions and share your views, because it's very much a discussion about trade ideas into the final quarter of 2012. And remember, this is an overview. Okay, thanks a lot, and greetings to Zetlos from the moon. Okay, so let's start now. So I'm just going to remind you, please feel free to send in your global photos from the country where you are living, and just email it to ronwilliampr@gmail.com. It's a great way for us just to connect visually, and with your permission, I may include some of these photos in future webinars, just for people to know where each of us are from. Okay, thanks. So let's start. Now, I always like to begin with the end in mind, and start with an agenda. And this agenda is 3 parts. First part is more of an overview. Are you a bull or a bear in the fourth quarter of 2012? A little bit about the summer risk rally and key event risk, which is happening in this week alone. And then a final point I want to make about multiple non-confirmations of the summer risk rally that we have seen in past months. Part 2, we talk about the new normal volatility paradigm. I'm going to show you a quick chart of the VIX volatility index, and just to make a point that volatility is here to stay post the financial crisis, and we should be more risk averse, although volatility is at historic lows at the moment. I'm going to visually try and explain the macro cycle roadmap that I always go by, and then just make a point or two about the global equity MSCI market as a leading indicator. Part 3, just to wrap up on a few potential high probability trade ideas, which will feature US dollar likely to resume higher, and gold surprising in more ways than one over the next few months. Okay, so let's start. And so my question to each of you here, I want to do a quick sentiment survey. How many of you are bullish in the fourth quarter of 2012, and why? So this is really, I want to start up by opening up this discussion to each of you here. All of you have very important ideas to share. Each of you are probably trading money and committing ideas to the market. So it is important to also share your views. So I want to start with your views. How many of you are bullish in the fourth quarter of 2012, the final quarter of 2012, and why? So I'm just going to quickly switch. So some of you are saying easy, QE3 bullish, bearish if it doesn't come out. So QE3 is a big question mark for some of you. And then Solomon is saying bullish, Euro problem is nearly over, so you're looking for some stability in Europe. Borki's asking about stocks. It could be about whichever market you prefer. So please choose the market you're looking for. But I guess my call is more on a stock market basis. Keep in mind that the stock market is a key indicator to the economic growth scenario. So if you're bullish on economic growth, you should be bullish on the stock market and general risk appetite. So yes, Borki, stocks would be part of that equation. GAM, flat on equities, probably Western, I'm guessing, unless Bernanke prints, bullish gold and miners. Hans-Jürgen, bullish euro crisis will not get any worse. And then trying trader, crash after the US election. So interesting. So you're waiting for the US elections before any kind of black swan events take place. Jan is saying not bullish or bearish, just following the market. I like that perspective. It's important to wait for market confirmation and let the market guide you. Mike Chandler, bearish, lack of global integrity among leaders of governments and corporations. Very good point, although it's not a market-specific point that you made there, Mike. It is very much economic and political risk-related, and that will dictate market movements or vice versa. Borki, hoping for the best. You're an optimist. That's very good. And Carlos, a little cautious about U.S. economy and the debt crisis resolution. Bernard, whatever the market does. So great, interesting forum of discussion there. And I think a lot of you are focusing on more event-related risk, either positive or negative. So including the Fed, the ECB, and various decisions that they might make over the next few weeks and months. Totolos is saying euro-dollar bullish because it's above the 200 moving average. There's quite a few risk appetite related markets which are above the 200 moving average, and I'll make a point about that. Certainly you can use moving averages as a good gauge of positive or negative bias. And Gan just at the end there saying no bias. Anyone else that would like to make a comment? Bullish or bearish in the final part of 2012? Anyone? Don't want to miss anyone out. Feel free to share any other additional views. Okay, I'll move on now. So so some of you are bullish into Q4 2012. The reasons why some of you are bullish, potentially if we get quantitative easing coming from the a further quantitative easing coming from the U.S. Fed Reserve, situation in Europe likely to stabilize because the worst is already over. And then the third reason that some of you mentioned is the U.S. presidential election, which, of course, as most of you know, usually triggers positive performance in the equity market due to increased optimism and government liquidity just ahead of the elections. Of course, the U.S. government would like to increase their chances of being re-elected, and so the best way to do that is to support the market with optimism and increased liquidity. So these are all reasons why you might be a bull into the final part of Q4 2012. Now, what about the reasons for being a bear? I think some of you cited it. Increased volatility, of course. I'll make the point that volatility is at record lows, and so for that reason, we should be a bit more averse to spikes in volatility, especially as we approach these months of September and October, where volatility seasonally rises and has done historically for many, many years. The markets are already very overextended. If we look at the stock markets in the West and a few other risk-related trades, and so for that reason might be under pressure for potential mean reversion setbacks back into their key support levels or their 200 moving averages. For example, the equity markets or Eurodollar, as was just mentioned. And keep in mind that timing is still everything. So whether you're bullish or bearish into the fourth quarter of 2012, you could be both. We could have a snapback down, which is my opinion, in September and October. So downside pressure in the next 2 months, and still have a positive setup for the U.S. elections at the end of the year. So think of it as a V-shape setup where we get a shakeout now for a rise end of the year. That's the roadmap that I'm working on at the moment. Now, we've all been watching the summer rally in risk appetite, and so two of the proxy markets that you could use just to illustrate that rise in optimism ever since the month of June is, of course, the S&P 500 and Eurodollar. And you can see the S&P 500 there on the left side, rising to new highs last seen since the 2008, which I'll show a chart on that in a second. And Eurodollar certainly having this very strong bounce back from very oversold levels, reaching up into that 130 psychological handle on Eurodollar. And certainly these two markets, S&P 500 and Eurodollar, are regularly seen as potential risk-related trades. Now, we have a week full of busy event risk, and today we have the ECB policy meeting confirming basically solutions to the peripheral risk out there in the market. How the market will react, we'll see later on today, but also for the rest of the week. So ECB is definitely an important event that is taking place today. Quantitative easing. This is a nice humorous cartoon that I've pulled out ahead of the Fed meeting tomorrow, where they'll be deciding whether there'll be another bout of quantitative easing. Now, this cartoon is a ship actually illustrating quantitative easing coming out of the UK a while ago, but it's a ship just saying, what are you doing now? And just put any government in charge there. Set course for quantitative easing. So you can see there they're on the cliff edge, the fiscal cliff, we could say, of the US fiscal cliff. And this kind of constant printing of money or quantitative easing is still deemed as the solution. But of course the question is for how long. So we need to ask ourselves, A, is there going to be further bout of quantitative easing? But B, we also need to keep in mind that each time there is quantitative easing coming out of each of the Western governments, but specifically the US, that each time there is a diminished effect. And this is what the cartoon is pretty much trying to illustrate, that we are on this fiscal cliff, and no amount of quantitative easing is really going to solve the situation. It'll only avoid the situation in the near future, just prolong the agony until we actually feel the pain later on. So that's quantitative easing scheduled for tomorrow, where we actually find out whether there will be quantitative easing or not. And then finally, more information about the new Apple iPhone 5. Why am I showing this to you? Because of course Apple is at record highs near around the $700 mark, and certainly Apple by itself is a juggernaut stock worth over 15% of the US stock market index. And so it is very much one of the mega cap stocks that is leading the rise higher in this risk-on phase in Western equity market. But also, Apple is a key economic indicator for Western markets. So we need to really watch out for this news that is coming out and see how the market reacts. So far, we've had a few bearish reversal sessions ahead of this key news about their new iPhone 5 module. And I'll have a few things to comment about each of these events. I'm just going to quickly go back out to see if there's any questions. So people are saying so far, market switching highs, good reasons to be bearish. Absolutely, Fernando. Harley saying plenty of politics involved. Yes, this is the point that I'm making here. Economic and political events. Trying trader, how are the US going to repay the Chinese? Very good question. And Harley's making a very good laughing joke about maybe some of the cartoons that I've just showed there, that the ship falling off the fiscal cliff. And then will boost GDP? Will the iPhone boost GDP? We'll find out. And final point from Gam, screen will be less smaller than the Samsung S3. We'll find out. I don't know. I'm not privy to any kind of secret information about the new iPhone 5, but it'll be interesting to see what happens. But the key reason why I'm showing you the iPhone 5 as a final event risk that we should be watching out for this week is purely because of the point we need to see how the market sentiment prices in this positive news for one of the biggest stocks out there in the world, Apple. And so keep in mind that how Apple, it's important to understand how Apple, the stock price for Apple will react with this very sensitive newsbreaker about the new iPhone, and then how Apple might domino effect on other markets, US stock markets, but then also just general economic sensitive proxies. So I'm going to tie this into Forex in a moment, but just keep in mind that a lot of this may be negative for euro dollar, Aussie dollar, and various other FX markets, which have been rising during the summer months following this risk trade. But ultimately, Boyke, just to answer your question in a sentence, I think that we are likely to see a sharp recovery in the US dollar over the next 2 months. And so more of a safe haven flow back into the US dollar, that reserve currency starting to be more supported over the next 2 months. So that would be negative currencies against the US dollar. And certainly for a lot of you that are looking for FX trades, that I would say sets you up for a lot of FX trades right here, right now that you might be watching. Okay, so that's just the event risk. Remember, I've just said ECB meeting, quantitative easing announcement for tomorrow from the Federal Reserve, and then the new Apple iPhone, a key gauge for economic movements, and of course the stock markets, because the Apple is such a large weighting in the stock market. Now, moving on quickly, everyone is talking about the U.S. stock markets making new highs, and certainly the S&P 500, the broad capitalized stock market, is an example of that. But keep in mind that the S&P 500 is still pressured by 2008 crisis levels, roughly at 1440 if you want a price level for the gauge for the index. And the key point here is that the market has a memory. Just like human beings have a memory, the market has a memory. And this memory is more of a negative memory that is likely to create pressure for the market. So we might push above 1440 for the short term, but my personal belief, my professional belief, is that this is an unsustainable move, partly because of these 2008 crisis levels that we are now pushing up against. Remember that point I made about Apple? Certainly the Apple stock price has been rising, as I like to say, irrationally, and there's been a huge performance year to date of well above 50%. And here we can see potential renewed exhaustion beneath that psychological $700 handle. Now, for those of you that might be invested in Apple for this year or even years before, I mean, first of all, congratulations on making fantastic profits in that stock alone. All I'm saying here is that you need to be a bit risk averse, maybe have a trailing stop, maybe reduce the position size. Just be aware that maybe adding to your Apple position at this moment in time might not be the best thing to do. Wait for new highs to add to that position if you really want to get more heavier, be more of a heavier buyer in Apple. But I would just be more aware of the downside risks than the upside potential, given that Apple has risen so much in such a short space of time. And look at the spread, the difference between between Apple's share price and the long-term moving average. It's been well above that for a long time, and you wouldn't sell just because of that, but it would still keep you risk averse. Just keeping in mind the massive outperformance from that long-term average, and just generally the irrational rise that we've seen so far. Second point I'll make is keep in mind that Apple is not just a stock. It is a mega cap company worth trillions of dollars that is very much an economic indicator for the US market and will have a domino effect on many portfolios, many funds out there that own this stock. So this will be an indication as to potential corrections coming in the next 2 months if we do see it. Now, one of the points here that I want to make is that there's a number of non-confirmations of the rise in the equity markets, and the point about Apple that I made is that that it might be a little overbought at the moment, but also that it's only the large mega cap stocks that are really rising to new highs. The broad stock market is not confirming the S&P 500 moves and various other new highs that we're seeing. And so one of those key classic examples is the Dow Transport Index, which is showing clear divergence for the entire year. And although we are seeing a little bit of a bounce back within that range in the last few weeks, there is still a classic Dow Transport non-confirmation with the Dow Jones Index, and of course with all the other major indices. The key message here is that this is telling you that basically the economic growth that is potentially being seen by the local stock markets making new highs is not being facilitated across the country, the US. But you can also, of course, use this as a global indication of that divergence. And I also use other transportation-related indices, such as the VOLATILITY Index and various other proxies, to also give a message about that, about the divergence of some of the growth stocks versus some of the transportation indices. Now, does anyone have any questions on what I've just shown there? Yeah, so very good point. Fernando saying, let me just quickly go. Babak is saying that now the economic situation is not like 2008. I agree, but I'm not sure whether you are bullish or bearish about that, Babak. My perspective is that we could be potentially hitting a similar parallel to 2008. Fernando is saying Apple is for sure a bubble, but bursting delayed after the Samsung court win. We'll find out. That's a very good point, that there are some internal dynamics there after the legal suit that took place between Samsung and Apple. And Mike Chandler makes the point that FedEx warned of lower profits, transportation, business services. Very good point, Mike. Thank you so much. So FedEx is a great signal that you can also throw into the mix with the Dow Jones Transportation and the Baltic Dry Index if you want to include shipping. So please take note of what Mike just said about the FedEx warning of lower profits. That is a very modern day example of non-confirmation from the transportation or from some of the service indices out there versus the growth stocks. Okay, so now I'm just going to talk about part two, the new normal volatility paradigm. I'm going to jump into the global MSCI market as a leading indicator and then wrap up on part three. Now, this new normal of volatility that I've alluded to several times, the best way I usually show you a distribution, a statistical distribution chart, but today I just want to quickly just show you the actual volatility measure of the VIX, so the US VIX measure. And this is the VIX going back to 2010, and I could have shown it to you going back to 2007, and what that would have shown you is that volatility is the lowest ever since pre-financial crisis 2007. And so while that's a very comforting point, it also tells you that this level of complacency is somewhat unsustainable, especially if you are in similar thinking to me, that there are still a lot of tail risks out there in the market, certainly as we move into September and October, into various other event risks that might hit us at any given time. The other point to make, other than that we're at historic complacency levels pre-2007 financial crisis, the other point is that since 2007, we have to keep in mind that this new normal means increased volatility. So that means higher spikes in volatility, and we did see that in 2007, mid-2007, and in the fourth quarter of 2011. Now, the key point here is that from a seasonality basis, volatility tends to spike in the months of September and October. And if you do any statistical analysis going back as far as 40 years, you'll see that time and time again, volatility traditionally rises during the seasons of September and October specifically, but generally the fourth quarter of each year and potentially 2012. And I would say this is more so likely to be the situation because volatility is historically low, and so there is further reversion risk to the upside. So a snapback to the upside above 20 on this index, but much higher. Now look how high the VIX does rise. It does move much above 30 into the 40-45 region, and this is the tail risk that most of the time we do not see. Now some of the tail risk out there we're aware of, like for example the risk in Europe, the risk in the US, but there are some event risks that are unknowns, the so-called black swan tail risks. And I always say this to industry colleagues of mine, that keep in mind the things that we do know, which are risk events, and also the events that we might not know at the moment. And so we might just want to be a bit more risk averse, maybe by using trading stops, by being a bit conservative about our profit targets and trying to collect in our profits as much as possible so we don't expose our profits in the market. The other thing is to also maybe try and hedge ourselves. So think of option strategies that you might want to take out just to protect your gains against potential downside in the market, or start to sell or buy markets which are which tend to perform well during volatile periods. You can maybe take out a contract on the VIX. You can maybe look at potential options for the US stock market, and so on. So just keep in mind, be a bit more risk averse in your trading tactics, but also maybe try and think of hedging yourself if there was an increase in volatility over the next 2 months. Okay, now one of the reasons why I'm still bearish is if we look at the global MSCI World Index, it has been positive in the second half of this year, but we are still within this potential multi-year distribution pattern. And certainly this fits in with my economic cycle roadmap. I don't have the cycle roadmap with me here on this webinar, but I'll show it in the next webinar. But just keep in mind that unless we break above the 2012 highs, and we still have some way to move in that direction, unless we move above that, this is a potential multi-year distribution pattern. And certainly with all those economic risks that we all know very well, it is something to keep in mind that we could see a further downside, and quite fast downside, into that red line, that neckline, which I just drew around the 1100 mark. Keep in mind that this would mean Western markets underperforming, but also it doesn't mean that the Eastern markets would be out of the woods. Certainly China is a key example of further slowdown taking place more than expected, and so we could see a global slowdown situation, not just not just specific to the Western market. Just want to quickly go back to the chat, see if there are any questions on what we've just shown. Borky's just making the point that we have a few minutes left before the end of the session, so yeah, we're just leading into the final part before we have Q&A. So I've kept this discussion just a little bit short so that we could keep it, so that I could cover just a quick overview for each of the webinars I cover. I will feature afterwards, but also so we could have some time for the Q&A. Trying Trade is asking, would you buy the VIX now? Good question. I think it would be a good strategy to have some exposure to the VIX. The only thing I'd mention about the VIX is you can get caught out on the VIX. You can get easily caught out on VIX, just purely because it is a quite active market, and it really depends on your trade tactic. Right now, if I were to buy the VIX, I would look to buy on a potential push to the upside. So I would put an entry level and wait for the VIX to actually punch above that entry level, as opposed to buy right now and then put a stop. The risk is that you might get stopped out several times because although the VIX is likely to push higher, in my opinion, the VIX has been at these levels for some time, and so you can get caught out in this further elongated VIX play. So short answer is yes, I would want to have some exposure to the VIX, but I would just be a bit careful about how you actually traded that move. Okay, does that help answer your question, trying trader? Yep. I'll take the potential. Okay, so for those of you asking about the VIX, I would say that, there are ETFs that you could take out there. There are VIX-related ETFs, both the VIX in the US, but also the VDAX, which is the German European equivalent, and some of the other European stock markets also have volatility indices that you could try. The ticker that you just put in, I'm not sure about that ticker itself, but there's plenty of ETFs that you could seek exposure. The other thing, of course, is you could potentially think about taking out some option contracts on some of these indices. So on the NASDAQ, on the S&P 500, on the German DAX, if you wanted. And in currency world, just keep in mind some of the risk trades such as Eurodollar, Aussie dollar, and so on, which might actually start to snap lower. Okay, now we're going to talk about the final points about what this might mean for the currencies and commodities section. There's just a few slides here that I've included. The problem is that if we do get a snapback in risk appetite, and this is a theme that I've spoken about for some time, it will create a domino effect back into safe haven trades, which has been long overdue. However, there's a key problem here. There are fewer places in the world to hide your money. So there are basically, in financial terms, less safe haven trades. Now, can anyone tell me what were the traditional safe haven trades in the market which have turned neutral to negative? Some of you tell me what were some of the popular traditional safe haven trades which just have been a bit neutral recently. So Harley's saying Swiss franc, absolutely, and the Swiss National Bank intervened and basically told the world, stay out of the Swiss currency because it's hurting our exports. Solomon saying, do you find out why you ended 2000 was a long way off the mark? I have to come back to which part of my forecast. So if Solomon, if you could be more specific about your question. Mike Chandler, the yen, absolutely, the yen. Although the yen's been a difficult one for some months now, I'm still very bearish on the yen, looking for negative yen appreciation. Solomon, yeah, thanks for coming back to me. On the yen, absolutely. It was a long-term cyclical reversal that I was looking for in the yen, and I'm still waiting for that, but it's just been a very kind of frustrating trade for myself and for various people that have been following that. I still believe that it's going to play out, but I just think the markets are just taking much longer than I had anticipated. I'll probably do a webinar on the yen to be a bit more specific about that. But the next webinar will be on the gold, on gold, by the way. And on that point, Gan makes the point that gold has, of course, been the traditional market that, although it's been pushing higher in recent weeks, for the greater part of this year, has been basically zigzagging sideways. So just list that out there on a piece of paper. The traditional safe haven trades in the market for the last year or so have been gold, Swiss franc, Japanese yen, and you could also throw into the mix treasuries. And each of these markets have disappointed time and time again. Now, gold approached that $2,000 mark, glass ceiling, and became an overcrowded trade. And like every market that becomes overcrowded, needs to unwind from that overbought, overcrowded scenario. And that's what we've seen in gold for some time, despite the economic and political risks, which should have made it push much above $2,000 and play out that safe haven trade that we all know and love. Swiss franc, central bank intervention. There is a currency war as we speak, and the Swiss National Bank, SNB, certainly led that debate by basically intervening in unprecedented way and letting the world basically know that it will support Euro Swiss as a proxy anytime people try and pile into the Swiss franc. We don't know how long that will last for, but it has lasted so far. And then, of course, the Japanese yen. There's many reasons why the Japanese yen hasn't performed as much as it used to as a safe haven currency. It has still provided some safe haven protection. But I think this is diminishing over time, and there's the key reason is there's structural changes happening in Japan and also on the actual price market. And my belief is that there's a long-term cycle that is currently reversing. But as Solomon mentioned, I was wrong about it taking place at the end of 2011, and it's likely to take much longer than that, potentially into the end of this year and early 2013. And then, of course, treasuries at historic lows, with all of this printing of money out there by central banks, it's pressurizing rates back to lows, and that's just giving some people no returns, or in some countries negative returns. But people are still willing to trade treasuries just because, relatively speaking, there are a few other places they can actually seek this type of safe haven trade. Now, what does all of this mean? So if there are fewer places to hide your money, if there are fewer safe haven trades in a potential setup where the market might unwind recent risk appetite, what does it mean? So which market is likely to get hit the most when all of these markets, these traditional safe haven trades, have basically disappointed, they're neutral, and they've reversed from their popular safe haven trends? Carlos has made the point, investors still consider the US dollar as a safe haven even in times of economic peril. Thank you so much for saying that, because that is my last slide that I'm going to show you, Carlos, that the US dollar is the one market that tends to receive a lot of safe haven interest during times of economic and political instability, but more specifically during times of increased market volatility. And keep in mind, we've had economic and political instability for many years now, ever since 2007. But it's all become really relative now. When is it really going to become so unstable that the market actually start to correct? But the one proxy we can use is the VIX, and general market volatility. Market volatility is at historic lows, and the general risk appetite proxies are overextended. So we should be more averse to potential correction in the seasonal volatile months of September and October. And so for those reasons, at this moment, the trade setup of Q4 2012 is the US dollar, certainly for the months of September and October. I'll mention a quick point about the US dollar and, of course, what that might mean for gold. Okay, so just one second, I'll flip back to the chart. So the fewest safe havens that we have been following all these years, gold, Swiss franc, Japanese yen, treasuries, have disappointed. And so for this reason, a lot of the safe haven flow that we are likely to see in the months of September and October as market volatility increases and some of these risk appetite trades unwind from these overcrowded levels, we're likely to see further shift into the US dollar. Now, if we look at this chart here, which is the US dollar index, we can see here that the US dollar index has been broadly positive since 2011 in this kind of jagged uptrend, represented by higher highs and higher lows. But of course, recently, the US dollar has unwound from these new highs in 2012 beneath the long-term 200 moving average. Now, what I'm saying here is that I don't think we're going to get past the spring lows on the US dollar index, seen here and here. And I think that the US dollar index is going to recover much higher. So just keep that in mind. And just finally, this is likely to add further pressure on gold. Gold has been positive, pushing above its 200 moving average. And while a lot of you might be getting very trigger happy on gold, and maybe buying or adding to your positions on gold, I'd be a bit more cautious. Feel free to have long positions in gold, but just have a trading stop nearby, because gold is still playing that dual personality of safe haven market and risk appetite trade. And if we do have a big unwinding in risk appetite during the months of September and October, gold is likely to be hit hard. I do believe that there is a big buying opportunity in gold this year, one of the biggest we've seen in many years, but I think it's all about timing. And so I'll end on that point. Any questions, please feel free to email me on ronwilliampr@gmail.com. enlightenment to realize knowledge. I really believe that any questions and discussion points that we share will increase our knowledge base, and so I really encourage it. And just a point here that the next webinar scheduled for the 17th of October at 2 GMT is on gold, a unique buying opportunity that must be timed. So just a key point there on the next webinar. Gold, a unique buying opportunity that must be timed. Please sign up as soon as you can, because we tend to get a lot of attendees during these market sessions. And again, if you have any questions, please email me on ronwilliampr@gmail.com, ronwilliampr@gmail.com. Also, if you could send me any wonderful photos of the countries where you're living in as well for that networking question that I asked at the beginning of this session. And feel free to follow me on Twitter, LinkedIn, and forexstreet.net. I'm just going to quickly flip back to the chat to see if there's any remaining questions before the next webinar. So, Harley Singh, looking forward to your next webinar. Thank you very much. Thank you, Fernanda, for your kind feedback. And Solomon, I left MIG Bank in August officially, and so I'm now currently independent, and there'll be new news coming out as to what I'll be doing soon. And just a quick question there from Trying Trader. Surely the Chinese will need to revalue their currency up to the US, will need to devalue their currency in order to pay back. If you think this is the case, why would you want to own any assets in the dollar? Okay, thank you, Trying Trader, for that question. The key point here is that any point about diversification out of the US dollar is a long-term, multi-year structural argument. And so what you need to keep in mind is timing. In the short to medium term, the US dollar story is still a story that we can trade for safe haven flows. So whenever risk increases, whenever risk appetite unwinds because of increased volatility, safe haven flows are likely to hit the US dollar hard, especially with the fewer safe haven trades which have disappointed. And the argument of, is the US dollar a good place to be given that there's a big economic fiscal cliff in the US and economic deterioration, and that the Chinese are likely to diversify out of the US dollar, unlike many other markets? Keep in mind that that is a long-term, multi-year argument that really it shouldn't be mixed up with the short to medium-term trade ideas, which I'm pitching here for the next month or two, September and October. And keep in mind, September, October increased volatility, but we might get some positive performance ahead of the US elections. Now, I've run out of time for questions, so I'm just going to wind up there just because I want to give time for the next webinar. And for some of you that had already questions there, please feel free to email me, and I'm happy to reply to your questions. Thank you very much for attending this webinar, new attendees and repeat attendees. Please email me with any further questions on ronwilliampr@gmail.com. Thank you very much for all of your time and your discussion. It's been an honor and a pleasure, as always. Enlightenment to realize knowledge. See you next month